Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in corporate reports. Today, we're diving into a filing that might seem a bit dry at first glance, but trust me, there is some juicy financial information lurking within. Get ready to crunch some numbers and see what they reveal about the Alternative Access First Priority CLO Bond ETF. Before we dive deep, if you find value in understanding these complex financial documents, hit that subscribe button. And hey, while you are at it, you should definitely join our Discord community. The link is in the description below for more exclusive content and discussions. Alright, so what are we looking at here? It is a semi-annual shareholder report for the Alternative Access First Priority CLO Bond ETF, or the fund covering the period from April 2025 to September 2025. Think of it as a mid-year checkup for this specific investment fund. First off, let's talk about how much it costs to invest in this fund. For a hypothetical $10,000 investment, the costs come out to just $13. That is a mere 0.25% of your investment, which is pretty good. Generally, lower expenses mean more of your money stays invested, working for you. Now let's look at some key numbers that tell us about the fund's size and how it is managed. The fund's net assets, meaning the total value of everything it holds minus its liabilities, stand at a little over $42 million. That is not a massive fund, but it is a significant amount. The portfolio holds 37 different investments, and importantly, the portfolio turnover rate is 18%. This means that over the reporting period, about 18% of the fund's holdings were bought and sold. A lower turnover rate often suggests a more buy and hold strategy, which can sometimes lead to lower trading costs and potentially better tax efficiency, although it really depends on the investment strategy. This table shows us where the bulk of the fund's money is invested. We see names like Fortress Credit BSL XXX Limited, AMC CLO XXE Limited, and Cedar Funding the 8th CLO Limited. These are all types of collateralized loan obligations, or CLOs. The top holdings are all clustered around 4.7% each, showing a decent diversification even within the top 10. This section details how the fund's assets are split up. The vast majority, 90.2%, is in collateralized mortgage obligations. That is a huge chunk. The remaining 9.8% is listed as other assets in excess of liabilities. This simply means there are other assets like cash or receivables that outweigh what the fund owes. Now we get to the nitty-gritty, the actual list of investments in the fund. This is where the real story is for a fund like this. We're looking at collateralized mortgage obligations, and they make up a massive 90.2% of the fund's total investments. Look at these names: AGL Core CLO IV Limited, AMC CLO XXI Limited, Battalion CLO X Limited. These are complex financial instruments commonly known as CLOs. For example, the fund holds $1,003,900 worth of AGL Core CLO IV Limited, Series 2020-4A. It has a coupon rate of 5.705%, which is the interest it pays out. Then there is AMC CLO XXI Limited with a principal amount of $2 million and a coupon of 5.635%. And look here, Cedar Funding the 8th CLO Limited with a principal of $2 million and a coupon of 5.542%. These CLOs are generally callable, meaning the issuer can pay them back early, and they are floating rate securities, meaning their interest payments can change based on market rates like SOFR, or the secured overnight financing rate. A lot of these are also considered restricted, meaning they can only be resolved to certain big financial players. The total value of these, as we saw before, is over $38 million. So, the total investments for the fund are valued at over $38 million, which represents 90.2% of its portfolio, and that is after costing the fund just over $38 million to acquire. This indicates the fund's investments are currently trading at a slight premium. And then we have those other assets which add up to about $4.1 million, making up that 9.8% we saw earlier. Putting it all together, the total net assets of the fund are just over $42.4 million. That's the total value investors have put into this specific fund. This statement gives us a snapshot of everything the fund owns and owes on the 30th of September, 2025. On the asset side, we have those investments valued at over $38 million, cash holdings of about $3.8 million, and interest and other receivables totaling around $470,000. On the liability side, we see payables for advisory fees and distributions, adding up to about $185,000. So, total assets are just over $42.6 million, and total liabilities are a relatively small $185,222. This leaves us with net assets of $42,419,604, which matches what we saw earlier. The fund has 1,700,000 shares issued and outstanding, and the net asset value per S-Share or NAV is $24.95. This is the per share value of the fund's underlying assets. Now let's look at how the fund performed over the 6 months ending the 30th of September 2025. Investment income, mainly from interest, was about $1.15 million. Expenses, primarily advisory fees, were around $53,000. This resulted in a net investment income of over $1.1 million. On the investment side, there was a net realized loss of about $126,000. However, there was a net change in unrealized appreciation of about $148,000. This means some investments increased in value. So combining those, the net realized and unrealized gain on investments was a positive $22,097. Overall, the fund saw a net increase in its net assets from operations of over $1.12 million for this 6-month period. That is a good sign, showing the fund is generating more than it is spending, and its investments are growing in value overall. This table bridges the gap between the beginning and end of the period, showing where the changes in net assets came from. We see that net investment income contributed positively, and there were net realized and unrealized gains, but also significant distributions to shareholders. The fund distributed over $1.1 million to its shareholders during this period. Then there are capital transactions. It looks like there were no new shares sold, but shares worth about $4.9 million were redeemed. This means investors, in aggregate, took more money out of the fund than they put in during this period. This outflow from redemptions led to a net decrease in the fund's total assets for the period by almost $5 million. The net assets at the beginning of the period were about $47.3 million, and they ended up at just over $42.4 million, reflecting that decrease. This section provides a per share look at the fund's performance over various periods. It is crucial for understanding the long-term picture. Let's focus on the 6 months ending the 30th of September 2025. The net asset value at the beginning of the period was $24.94. Income from investment operations, or net investment income, added $0.65 per S-share, and there was a net realized and unrealized gain of essentially zero for this specific short period. So the total from investment operations before distributions was $0.65 per S-share. The fund paid out $0.65 per S-share in distributions. This brings the net asset value at the end of the period to $24.95 per S-share, a slight increase from the beginning. The total return for this 6-month period was 2.69%. This is the overall percentage gain or loss an investor would have seen, assuming reinvestment of dividends. Looking at the ratios, we see the expense ratio remains a consistent 0.25%, which is excellent. The ratio of net investment income to average net assets is 5.16%, indicating a healthy income generation relative to the fund size. And the portfolio turnover rate for this period was 18%, as we saw in the key statistics. This note explains how the fund was set up. It is a series of the Investment Managers Series Trust II, a Delaware statutory trust. Its main goal is to preserve capital and generate income. It is an actively managed exchange traded fund, or ETF. Interestingly, it underwent a reorganization on the 14th of October 2022. Essentially acquiring the assets and liabilities of a predecessor fund. This means the historical performance and accounting data before that date actually belongs to that previous fund, which is important for understanding long-term trends. This section details the accounting rules the fund follows. A key part is how they value their investments. For debt securities like the clause the fund holds, they use pricing services that take into account things like yields on similar bonds, credit ratings, and market conditions. If a price isn't readily available, they use fair value, which is an estimate of what they'd get if they sold it right now. The fund's advisor is responsible for making these fair value determinations, with oversight from the Board of Trustees. Here we learn about the major players involved. The fund pays an investment advisory fee to Alternative Access Funds, LLC, the advisor, at an annual rate of 0.25% of the fund's average daily net assets. The advisor is responsible for most of the fund's expenses, which aligns with the low expense ratio we saw earlier. Other key services like fund accounting, transfer agency, and custodian are handled by Brown Brothers Harriman. This part is about taxes. The fund aims to meet the requirements to be a regulated investment company, meaning it distributes most of its income and gains to shareholders, so it generally doesn't pay federal income taxes itself. It also details the fund's cost basis for investments, unrealized appreciation and depreciation, and capital loss carry forwards. For tax purposes, the fund's cost of investments was over $38.2 million, with a net unrealized appreciation of about $28,000. For the 6 months ending the 30th of September 2025, the fund purchased about $7 million worth of investments and sold about $14.8 million. This indicates a net selling of investments during this period. This note explains the different levels used to categorize investments based on how their fair value is determined, from quoted prices in active markets to unobservable inputs. For this fund, all of its investments in collateralized mortgage obligations, totaling over $38.2 million, are categorized as Level 2. This means their value is determined using observable inputs like market data, but not necessarily quoted prices for identical securities in active markets. This suggests the valuation relies on models and market indicators rather than direct trading prices. This is a standard but important disclosure. It warns investors that various global events like wars, pandemics, or economic instability can significantly impact the fund's investments and its overall performance. The ultimate impact is unpredictable, but it is a risk all investors need to be aware of. This section covers upcoming changes in accounting rules. For example, there is a new standard coming out that will change income tax disclosures. Management is evaluating how these will affect the fund's financial statements. Finally, the principal executive and financial officers have confirmed that the fund's internal controls and procedures are effective, meaning they are designed to ensure that important information is properly recorded, processed, and reported. There were no significant changes to these internal controls during the reporting period. And that wraps up our deep dive into the 30th of September 2025 report for the Alternative Access First Priority CLO Bond ETF. Now let's talk about what this all means. The fund is heavily concentrated in CLOs, making up over 90% of its assets. This is a calculated strategy, aiming for income and capital preservation, but it also means the fund's performance is closely tied to the performance of the CLO market. The expense ratio is commendably low, which is a big plus for investors, and the fund generated positive net investment income in the last 6 months. However, we also saw that net outflows from share redemptions. This suggests that investors on balance are taking money out of the fund. While the fund itself is performing reasonably well in terms of income generation, this outflow trend warrants attention. It could indicate investor concerns about the CLO market, the fund's strategy, or simply a reallocation of assets by investors. The valuations of these CLOs are based on observable inputs, but not directly quoted prices, which means there is still an element of estimation involved in their valuation, and market fluctuations can impact them significantly. Overall, this fund appears to be operating as intended, delivering income from a specialized asset class with low fees. The key risk for investors will be the volatility and health of the CLO market itself, and the potential for continued investor redemptions. It is a fund for those who understand and are comfortable with the risks associated with CLOs. Alright, that is our breakdown of the Alternative Access First Priority CLO Bond ETF's latest filing. What is your take on these numbers and what they signal for the fund's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more exclusive content. Thanks for watching. See you next time.